Hello there and welcome to this video. Look, let's be honest. Auditing debt obligations and stockholders' equity transactions doesn't exactly have the same ring to it as, say, free puppies for everyone. It's more like the accounting equivalent of finding a rogue quinoa salad in the back of your fridge. You know it's important, you know you should deal with it, but it's not exactly what you want to be doing on a Friday night. But here's the thing, this stuff matters. Because much like that quinoa salad, if you ignore it for too long, things can get messy. We're talking potential financial disasters, regulatory nightmares, and enough paperwork to make a bureaucrat blush. So whether you're a seasoned accounting professional or just starting out, consider this your comprehensive guide to navigating the wild world of debt and equity audits. We'll break down the key steps, sprinkle in some real-world examples, and hopefully make this whole process a little less painful than a tax audit conducted entirely in mime. Let's get started, shall we? Right, before you charge into any audit, you need to know what you're dealing with. It's like trying to perform surgery. You wouldn't go in without knowing if you're operating on a knee or, say, a tuba. In this case, we're talking about identifying the significant accounts and disclosures related to debt and equity. Think of it like this, and debt is essentially what a company owes to others. We're talking about things like bonds, loans, those buy now, pay later schemes that are rapidly becoming the background music of our lives. Each of these comes with its own set of accounting rules and disclosures. And yes, you guessed it, potential pitfalls. Equity, on the other hand, represents the owner's stake in the company. This is where you'll find common stock, preferred stock, and retained earnings, basically the financial building blocks of a company. And just like with debt, there are key disclosures and assertions that need to be carefully examined. Now, why are these assertions so important? Because they're essentially management's claims about the financial statements. They're saying, trust us, this is all above board, and as auditors, it's our job to channel our inner skeptic and say, oh really, prove it. We're looking for evidence to support those assertions, whether it's confirming the existence of debt, making sure those equity transactions are recorded correctly, or verifying that everything is disclosed as it should be. Because let's be honest, in the world of finance, things aren't always as they seem. Remember Enron? Yeah, case in point. So, as you embark on your audit journey, keep in mind, understanding the key accounts, disclosures, and assertions is like packing the right gear for a hike. Get it right, and you'll be well equipped to handle whatever the financial wilderness throws at you. Get it wrong, and, well, let's just say you'll be wishing you packed that satellite phone. All right, now that we've got a handle on the key players, it's time to talk about risk, specifically inherent risk. The risk that something's amiss in the financial statements even before considering internal controls. Think of it like this. Inherent risk is the reason your friend with a system for picking lottery numbers still hasn't won the jackpot. When it comes to debt and equity, inherent risks can pop up faster than a telemarketer at dinner time. For example, complex financial instruments like those mortgage-backed securities that nearly brought down the financial system back in 2008. Yeah, those are riddled with inherent risk. Then there's the potential for management override of controls. This is where things get really juicy because even with the best internal controls in place, there's always the risk that someone in a position of power could say, you know what, let's just skip those pesky rules and cook the books a little, and let's not forget about the ever-changing accounting standards. It's like trying to hit a moving target while riding a unicycle on a tightrope. Just when you think you've got a handle on the rules, they change again, leaving you teetering on the edge of a financial faux pas. So how do we navigate this minefield of inherent risk? By being proactive, that's how. We need to understand the company, its industry, and the specific transactions it's engaged in. We need to ask tough questions, dig deep into the details, and never ever assume that everything is as it seems. Remember, auditing is not for the faint of heart. It's about asking the uncomfortable questions, challenging assumptions, and ultimately providing reasonable assurance that the financial statements are free from material misstatement. And in a world where financial scandals seem to be as common as bad reality TV, that's a responsibility we don't take lightly. Okay, let's talk about the elephant in the room, or rather the embezzler in the boardroom, fraud risk, because while inherent risk is all about the potential for unintentional errors, fraud risk is a whole different beast. It's the deliberate manipulation of financial information, and it can range from small-time expense report padding to full-blown corporate scandals. Now, when it comes to debt and equity, there are some classic fraud schemes to watch out for. One of the most common is improper capitalization of expenses. This is where companies try to make their earnings look better by classifying expenses as assets. It's like trying to pass off your daily latte habit as a long-term investment. Sure, you might convince yourself for a while, but eventually the auditors are going to come knocking. Then there's the ever-popular revenue recognition shenanigans. This is where companies try to inflate their revenue by booking sales that haven't actually occurred or that they don't actually expect to collect on. It's like trying to pay your rent with monopoly money. It might work in the game, but it's not going to fly in the real world. And of course, we can't forget about good old-fashioned management override of controls. This is where those in charge decide to throw caution to the wind and manipulate the financial statements for personal gain. It's like the financial equivalent of robbing a bank and then leaving your business card at the scene of the crime. So how do we combat these nefarious schemes? By being vigilant, skeptical, and perhaps a little bit paranoid. We need to look for red flags such as unusual transactions, unexplained fluctuations in account balances, or a general lack of documentation. And when we find something fishy, we need to dig deeper, ask tough questions, and not be afraid to raise the alarm. Remember, as auditors, we're not just number crunchers, we're financial detectives. And it's our job to make sure that the financial statements are a true and fair representation of the company's financial position. Because when it comes to fraud, the truth is out there, and it's our job to find it. All right, let's talk about control risk. This is the risk that a material misstatement could occur and not be prevented or detected by a company's internal controls. Think of internal controls as the financial equivalent of a good security system. You've got your locks, your alarms, and maybe even a guard dog or two to keep the bad guys out. But just like any security system, internal controls are only as good as the people who design, implement, and maintain them. And that's where things can get a little dicey. Because even with the best intentions, companies can have weaknesses in their internal controls. For example, let's say a company has a policy that requires 2 signatures on every check over a certain amount. Sounds good in theory, right? But what if the employee who's supposed to be getting the second signature is also the one who's writing the checks? That's a control weakness. Or let's say a company has a system in place for authorizing and recording debt transactions. But what if the person responsible for entering the data into the system is overworked, underpaid, and prone to making mistakes? That's another control weakness. And then there's always the risk of collusion, where 2 or more people work together to circumvent the controls. It's like something out of a heist movie, except instead of stealing diamonds, they're cooking the books. So how do we assess control risk? By performing tests of controls, of course. This involves examining the design and operating effectiveness of the controls in place. We'll look at things like whether the controls are properly documented, whether they're being performed consistently, and whether they're actually preventing or detecting misstatements. And if we find weaknesses in the controls, well, that's where things get interesting, because it means we need to adjust our audit approach to reflect the increased risk. We might need to perform more substantive procedures which are designed to detect material misstatements at the assertion level. Now let's talk about a powerful tool in our auditing arsenal: analytical procedures. Think of these as the financial equivalent of a detective dusting for fingerprints. They help us identify unusual patterns or trends that might indicate a problem. Analytical procedures involve comparing financial information to expectations developed by the auditor. For example, we might compare a company's current year debt-to-equity ratio to its prior year ratio or to industry averages. If we see a significant difference, it could be a red flag that something's not quite right. Or let's say we're looking at a company's interest expense. We would expect interest expense to be higher if the company has taken on more debt. So if we see interest expense going down but debt levels going up, that's another red flag. Analytical procedures can also help us identify potential fraud risks. For example, if we see a company's revenue increasing at a much faster rate than its expenses, it could be a sign of revenue manipulation. Now, it's important to note that analytical procedures are just one tool in our auditing toolkit. They're not a substitute for other audit procedures, such as tests of controls and substantive procedures, but they're a valuable tool nonetheless, and they can help us identify potential problems early on in the audit, which can save us a lot of time and headaches down the road. So the next time you're planning an audit, don't forget about the power of analytical procedures. They might just help you crack the case wide open. Okay, so we've identified the risks. Now what? Well, we can't just sit on our hands and hope for the best. We need to respond to those risks in a way that's appropriate given the circumstances. The first step is to assess the likelihood and magnitude of the identified risks. How likely are they to occur, and if they do occur, what's the potential impact on the financial statements? Once we have a handle on that, we can start developing our audit approach. If the risks are low, we might be able to get away with performing less extensive audit procedures. But if the risks are high, we're going to need to bring out the big guns. This could involve performing more tests of controls, increasing the sample size for our substantive procedures, or even hiring specialists to help us with certain aspects of the audit. It's also important to remember that our risk assessment is not a one-time event. We need to continually reassess the risks throughout the audit as new information comes to light. For example, if we find a weakness in internal controls that we didn't identify during our initial assessment, we're going to need to adjust our audit approach accordingly. Responding to risk is all about being proactive and adaptable. We can't predict the future, but we can prepare for it. And by carefully considering the risks of material misstatement, we can increase our chances of detecting and preventing fraud and ultimately providing our clients with the high-quality audits they deserve. All right, we've talked about the importance of internal controls, but how do we know if those controls are actually working? That's where tests of controls come in. Tests of controls are designed to evaluate the operating effectiveness of internal controls in preventing or detecting material misstatements. Essentially, we're putting those controls through their paces to see if they hold up under pressure. There are a variety of tests of controls we can perform, depending on the nature of the control and the level of assurance we're looking for. One common test is inquiry. This involves simply asking management or other employees about how the control is performed. Another common test is observation. This involves watching the control being performed to see if it's being done according to policy. For example, if a company has a control that requires 2 people to open the mail each morning, we might observe the mail opening process to make sure that 2 people are actually involved. We can also perform tests of controls by inspecting documents and records. For example, if a company has a control that requires all invoices to be approved before they're paid, we might inspect a sample of invoices to make sure that they've been properly approved. The results of our tests of controls will help us determine whether we can rely on the controls to mitigate the risk of material misstatement. If the controls are effective, we might be able to reduce the amount of substantive testing we perform. But if the controls are ineffective, we're going to need to increase our substantive testing to compensate for the increased risk. All right, let's talk about the bread and butter of auditing substantive procedures. These are the procedures we perform to detect material misstatements at the assertion level. Essentially, we're looking for hard evidence to support the amounts and disclosures in the financial statements. There are 2 main types of substantive procedures: tests of details and substantive analytical procedures. Tests of details involve examining individual transactions, account balances, and disclosures. For example, we might confirm accounts receivable balances with customers, vouch inventory counts to supporting documentation, or review contracts to verify the terms of debt agreements. Substantive analytical procedures, on the other hand, involve analyzing plausible relationships among both financial and non-financial data. For example, we might compare a company's gross profit margin to its prior year margin or to industry averages. If we see a significant difference, it could indicate a problem with revenue recognition or cost of goods sold. The specific substantive procedures we perform will depend on a number of factors, including the nature of the account or disclosure being audited, the assessed risk of material misstatement, and the availability of audit evidence. But regardless of the specific procedures we perform, our goal is always the same: to obtain sufficient appropriate audit evidence to support our audit opinion. So the next time you're planning an audit, don't forget about the importance of substantive procedures. They're the key to unlocking the truth behind the numbers. All right, let's talk about something that's near and dear to every auditor's heart, ethics, because even though we might spend our days poring over spreadsheets and financial statements, we're not robots. We're human beings with a moral compass, and it's important that we bring that compass to work with us every day. As auditors, we are entrusted with a great deal of responsibility. We're responsible for providing independent and objective opinions on the fairness of financial statements, and that means we need to be ethical in everything we do. The AICPA Code of Professional Conduct provides a framework for ethical decision-making. The code outlines 6 principles that should guide our behavior: responsibilities, the public interest, integrity, objectivity and independence, due care and scope and nature of services. These principles are more than just words on a page. They're the foundation of our profession, and they should inform every decision we make. When we're faced with an ethical dilemma, we need to ask ourselves, what would a reasonable and informed third party think? Are we acting in the best interest of the public? Are we maintaining our objectivity and independence? It's also important to remember that ethical dilemmas aren't always clear-cut. There are often shades of grey, and there might not be a single right answer, but by carefully considering the principles outlined in the Code of Professional Conduct, we can make decisions that are ethical and defensible. So, the next time you're faced with a tough decision, don't be afraid to consult your moral compass. It might just be the most important tool you have. And there you have it. We've journeyed through the intricate world of auditing debt obligations and stockholders' equity transactions. We've explored the key accounts, sniffed out those pesky inherent risks, and even channeled our inner Sherlock Holmes to spot those fraudulent red flags. Remember, auditing isn't just about crunching numbers. It's about asking the right questions, thinking critically, and always maintaining your professional skepticism. Because when it comes to financial statements, things aren't always as they seem. So go forth armed with your newfound knowledge and tackle those audits with confidence. And who knows, you might even find yourself enjoying the process. Or at the very least, you'll be able to sleep soundly at night knowing that you've done your due diligence.